Welcome to the Ontario Mortgage and Real Estate Insights podcast, where we cover the latest developments, trends, and regulatory changes affecting the industry. I am your host, Steve Hamoen. Today, we have some exciting news to discuss, starting with the combined value of Ontario real estate, which is now estimated at a staggering $314 trillion. You heard that right. The Municipal Property Assessment Corporation has estimated that the total value of all real estate in Ontario has reached $314 trillion. This is a significant increase from their previous tally, which was $42 billion less just a year ago. A major contributing factor to this increase is the new construction happening across the province. For instance, new developments at sites like 407 Dundas Street West in Oakville have played a substantial role in raising the overall value. This rise in property values is not just limited to residential real estate. Commercial properties have also seen a notable uptick in value. In Toronto alone, property values have surged to $9.93 billion, according to the Municipal Property Assessment Corporation report. The increase in property values can have a range of implications. For homeowners, this might mean a rise in home equity, which can be beneficial if you are looking to refinance or sell. For potential buyers, however, it might mean facing higher prices and a more competitive market. It is also worth noting that higher property values can lead to higher property taxes, which could impact both homeowners and commercial property owners. This is something to keep an eye on, especially as municipalities adjust their tax assessments based on these new valuations. Overall, the $314 trillion valuation is a testament to the robust real estate market in Ontario. Whether you are a homeowner, investor, or real estate professional, staying informed about these changes is crucial for making well-informed decisions. Today, we have some exciting news to discuss about the federal government's latest investment in affordable housing in Toronto. The Honourable Gary Anandasangari, Minister of Crown Indigenous Relations and Member of Parliament for Scarborough, Rouge Park recently announced more than $105 million in contributions and low-cost loans through the Affordable Housing Fund. This initiative aims to build and repair over 5,200 affordable homes in Toronto. This announcement was made at Gower Park Place, a 164-unit apartment building located at 10 Gower Street in East York. Operated by the Vincent Paul Family Homes Corporation, this site provides affordable housing to low-income families, seniors, singles, persons with disabilities, and others in need. During the event, Minister Anandasangari also revealed an additional $30 million in funding for the Governing Council of the Salvation Army in Canada. This funding will be used to repair 3,000 units across the country. The Honourable Sean Fraser, Minister of Housing, Infrastructure and Communities, emphasized the importance of this investment. He stated, "Everyone deserves a place to call their own, and the Affordable Housing Fund is one way we're helping make that a reality for Canadians. We will keep investing in affordable housing projects like the ones announced today and working with partners across the country to end the housing crisis." Minister Anandasangari added, "We've heard the people of Toronto loud and clear. Build good homes fast, and that is exactly what we're working to do. Today's announcement means over 5,000 new affordable units in our great city. That's homes for students, families, and hardworking Canadians across the board. We'll continue to be ambitious and keep building." Nathaniel Erskine Smith, Member of Parliament for Beaches East York, also weighed in on the significance of this investment. He noted, "To address both productivity and fairness challenges, there is no issue more important to this city and country right now than housing affordability." Here are some quick facts to give you a better sense of the scope of this initiative. The federal funding announced is helping to create a total of 206 new homes and leading to the repairs of 5,029 homes in Toronto. Additionally, the Affordable Housing Fund provides funding through low-interest and forgivable loans or contributions to help build new affordable homes and renovate and repair existing, affordable, and community housing. Through the 2023 Fall Economic Statement, the government announced an additional $1 billion for the Affordable Housing Fund, bringing the total funding to over $14 billion. To further support nonprofit, cooperative, and public housing providers and respond to the needs of those most impacted by the housing crisis, Budget 2024 committed an additional $1 billion to the fund, This program, under the National Housing Strategy, gives priority to projects that help people who need it most, including women and children fleeing family violence, seniors, Indigenous peoples, people living with disabilities, those with mental health or addiction issues, veterans and young adults. As of March 2024, the federal government has committed $50.97 billion through the National Housing Strategy to support the creation of over 146,000 units and the repair of over 286,000 units. To support the government's work to grow housing supply and address the need for more affordable and rental homes, the Canada Mortgage and Housing Corporation is implementing the Frequent Builder Framework. This framework will help expedite applications for the Affordable Housing Fund and the Apartment Construction Loan Program. Frequent builder status is given to existing housing providers with a proven track record of building multi-residential units. Different criteria apply to governments, nonprofit, and for-profit organizations to qualify for frequent builder status. These builders may receive benefits such as priority treatment, a streamlined process through intake, underwriting, and approval stages, underwriting and advancing flexibilities, as well as the possibility of funding commitments for future years. This allows funding predictability and better planning for their pipeline of projects. Overall, this significant investment by the federal government is a promising step toward addressing the housing crisis in Toronto and across Canada. By focusing on building and repairing affordable homes, the government aims to make a tangible difference in the lives of many Canadians. A new report by Statistics Canada reveals that the number of short-term rental listings in Canada has increased by more than 60% between 2017 and 2023. The report identifies over 100,000 short-term rentals that could potentially be converted into long-term homes. This figure, while significant, represents less than 1% of Canada's total housing units. The report highlights that the highest growth in short-term rentals has been observed in British Columbia and Ontario. This surge has fueled ongoing debates, particularly in British Columbia, where recent regulations have been introduced to restrict short-term rentals to principal residences in an effort to bolster the long-term housing market. Proponents of these new regulations argue that any housing added to the available stock will help alleviate the current housing crisis. However, owners of short-term rentals and platforms like Airbnb contend that these measures will not make a significant difference. According to Marie-Christine Bernard, Assistant Director of Statistics Canada and co-author of the report, the research did not examine the impact of short-term rentals on affordability or vacancy rates. Bernard emphasized that the significance of short-term rentals varies depending on the community. To identify which short-term rental units could potentially become long-term housing, researchers focused on units that were not vacation homes, offered an entire house instead of just a private room, and were available for rent at least 180 days out of the year. The data only includes short-term rentals listed on Airbnb and VRBO platforms. The report found that British Columbia had the highest percentage of short-term rental units suitable for long-term housing, followed by Prince Edward Island. Although short-term rentals make up a small percentage of the overall housing stock, leaders in British Columbia argue that returning some of these units to the long-term market could significantly help those struggling to find homes. British Columbia is also ramping up enforcement efforts of its new short-term rental restrictions. A preliminary analysis by the province found more than 10,000 listings operating illegally. The province's housing minister, Ravi Kahlon, has emphasized the difficulty in adding to the available housing stock due to the growing number of units used for short-term rentals. In Ontario and British Columbia, the number of short-term rental units that could potentially become long-term homes was the highest in 2023, with 38,955 and 29,643 units, respectively. Thorben Wieditz, executive director of the advocacy group Fairbnb, argues that looking at vacancy rates in specific municipalities is a more effective way to determine the impact of short-term rentals on the housing market. A national vacancy rate of 1.5% was reported by the Canadian Mortgage and Housing Corporation in January, the lowest rate on record. Viditz's analysis suggests that adding the 100,000 potential long-term dwellings back into the market could raise this rate to 2.4%. Vancouver, with a vacancy rate of 0.9%, is the nation's tightest major rental market and has the highest monthly average rents. While short-term rentals have not caused the housing crisis, Viditz notes that they do contribute to and exacerbate existing housing issues. Nathan Rotman, Airbnb's regional lead for the northeastern United States and Canada, believes that the new short-term rental restrictions in British Columbia will not significantly impact the housing market. He argues that while there will be fewer short-term rentals, the changes will have a more substantial effect on jobs supporting the tourist economy. Marie-Christine Bernard of Statistics Canada cautions that just because the study identified over 100,000 potential long-term dwellings, it does not mean all these units would return to the market if they were no longer short-term rentals. She suggests that the impact of regulations should be studied on a community-by-community basis. Overall, the report by Statistics Canada sheds light on the complex dynamics between short-term rentals and the housing market. While converting some short-term rentals to long-term housing could provide relief, the broader impact remains a topic of debate among policymakers, researchers, and industry stakeholders. A recent report from the Calgary Real Estate Board reveals that home sales in Calgary dropped by 10% in July compared to the same period last year. A total of 2,380 properties were sold, marking a significant decline in transactions. Despite the drop in sales, the benchmark price across all home types remained steady at $606,700 for July. This price is similar to last month and reflects nearly an 8% increase from last year. Anne-Marie Lurie, the chief economist at the Calgary Real Estate Board, commented on the market's current state. She noted that while the Calgary market continues to struggle with the supply of lower-priced homes, an increase in options in both the new and resale markets has helped to dampen the pace of home price growth. Lurie added that these results align with expectations for the second half of the year. She mentioned that if inventory levels continue to rise, it could result in more stable home prices moving forward. In July, inventory levels topped 4,000 units for the first time in nearly 2 years, although this figure still remains 33% below typical July levels. The Calgary Real Estate Board indicated that the highest supply growth was observed for homes priced above $600,000. The rise in inventory has contributed to a shift away from the extreme seller's market conditions seen in the spring. This shift is expected to continue as more homes enter the market. Overall, the report by the Calgary Real Estate Board highlights the dynamic nature of the Calgary housing market. While sales have declined, the increase in inventory and steady price growth suggest a more balanced and stable market environment in the coming months. Now let's talk about an important question. How much mortgage can you get with a $100,000 salary? This is a topic that many potential homebuyers are curious about, and it is crucial to understand the variables that can affect your mortgage eligibility. A person making $100,000 in Canada may be able to afford a mortgage around $575,000. However, the mortgage amount you will qualify for ultimately depends on several factors, including your credit score, debt, and current interest rates. First, let us break down the numbers. To estimate how much mortgage you can get with a salary of $100,000, you need to calculate your monthly income. By dividing your annual salary of $100,000 by 12, you get a monthly pay of $8,333. Next, you need to find your monthly mortgage maximum. No more than 39% of your income can go toward your mortgage payment, including property taxes and utilities, according to a common lender measurement called the gross debt service ratio. So a monthly salary of $8,333 multiplied by 0.39 is $3,250. Now let us determine the price range of houses you should be looking at. If you are approved for a 25-year mortgage with an interest rate of 5%, that $3,250 monthly payment translates into a home price of about $575,000 with a 20% down payment. But keep in mind, these numbers may not apply to everyone who makes $100,000 per year. The overall state of your personal finances goes well beyond your income and has a big effect on the amount of mortgage you can get with a $100,000 salary. One key factor that affects your mortgage eligibility is your credit score. The example above assumes a mortgage interest rate of 5%, but this rate may not be available when you apply for a mortgage. Your entire mortgage application, which includes your credit score, will be reviewed before you receive an offer. A credit score that is good but not great may result in a rate above the lowest advertised rates. Another reason the estimate may not apply to you is that it includes property taxes of 0.5% per year and about $333 in monthly home insurance and other ongoing costs, like utilities. Your housing-related expenses might be different depending on where in Canada you live. Lenders in Canada limit the maximum amount you can borrow based on two debt measurements, the gross debt service ratio and the total debt service ratio. As mentioned earlier, no more than 39% of your income can go toward your mortgage payment, taxes, and utilities under the gross debt service ratio. The total debt service ratio takes into account your other monthly debt payments, such as student loans and credit card payments. Lenders generally do not want the total of these payments, plus any mortgage payment, to exceed 40 to 44% of your income. To give you a clearer picture, let us look at a couple of sample housing budgets. Consider two people with identical $100,000 incomes, Person A and Person B. Person A has no car payment and no credit card debt, whereas Person B has a $500 car payment and a $250 credit card debt payment. For Person A, the gross debt service ratio limit is $3,250, and the total debt service ratio limit is $3,667. For Person B, the gross debt service ratio limit is also $3,950, but the total debt service ratio limit is $2,917. This example does not even take into account differences in credit scores. The better your score, the lower the rate you will get. Even if two people can afford the same monthly payment, the person with the better credit score can potentially afford a more expensive home if less of that monthly payment is going toward interest. If you want to get a more accurate estimate tailored to your situation, you can use a mortgage affordability calculator. This tool allows you to control more variables when estimating mortgage payments. If your estimated price range does not match your hopes, here are some steps you can take. Improve your credit by reducing or eliminating credit card debt. Reduce set monthly expenses, expand your search to different neighborhoods, and keep saving for a larger down payment. Patience is also key. A drop in interest rates or a new job can change your prospects. Overall, understanding how much mortgage you can get with a $100,000 salary involves considering a variety of factors. By being aware of these variables and planning accordingly, you can set yourself up for home buying success. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found this information useful as you navigate the real estate market. Stay tuned for our next episode, where we will continue to bring you the latest insights and updates. Thanks for listening, and have a great day.